Welcome to the Overberg Asset Management Market Review. In this episode, Nick and Gielie shares with us the highlights of the markets, both globally and in South Africa.
Good day and welcome. In the UK, Canada and Australia, where they went gangbusters, incurring more and more debt to fuel residential property bubbles. So those are the fragile economies, and we've seen it over the last week or so in the UK with a decline in sterling. So that is a problem, and even though those economies are fairly small in the wider scheme of things, there is the potential for global contagion effects in the worldwide financial markets. And certainly we have seen the effect of the UK mini budget on confidence across the world in financial markets over the last week or so. Please read the weekly market report yesterday. There was a segment on the global side regarding the pound, where to from now, some explanation of why the pound has dropped so much. And obviously also very good research from Gielie as well on the local segment. What is the view from the different analysts? I'm going to start off with macro strategy partnerships. It's a little bit scary talking about inflation specifically in the US, but also in Europe and the UK, and what that means for interest rates, monetary policy, and how high interest rates need to go in order to defeat inflation on a sustainable basis. Beating inflation requires positive real rates. And here's a quote from Charlie Munger. Inflation is the way that democracies die. It's the biggest long-run danger we have, apart from nuclear war. So that's saying quite something. US inflation has peaked, but the chance of it returning smoothly to target is slight, as some members of the Federal Reserve now acknowledge to have any hope of controlling inflation, even in the near term, real policy rates need to be positive. So the real rate is the interest rate minus the inflation rate. So real rates are still very negative at the moment. The Fed funds rate, even after the last increase of 0.75%, is at 3.25%. Inflation is at 8.3%. And if you look at nominal GDP growth rate, so that's GDP plus inflation, nominal GDP growth in the US is 9.4%. The Fed funds may need to go up considerably further from where we are at the moment, and far more than the markets are currently discounting. So let's look at some of the historical context. With 2/3 of the CPI basket in the US in services, and thus subject to long and variable built-in lags, the past experience of inflation in 1947, 1951, 1974, and 1980 shows that once it has initially broken out into double digits, it tends to become deeply cyclical. A couple of years ago, nobody had heard of him. Now we're all talking about Paul Volcker, the Fed chairman who only beat 20 years of rising inflation by taking the real Fed funds rate as high as 1,300 basis points in April 1982. And crucially, the Fed then kept real policy rates at an average of almost 500 basis points for the next decade. The Fed, no matter how recently converted to hawkishness, remains woefully behind the curve on a historic basis. And this is relevant to the US dollar. A lot of people may think that the US dollar is run too hard and surely cannot appreciate any further from here. But this is important. they emphasize how very different the situation is in Europe, and that, in this instance, includes the UK, how different the situation is in that region compared to the US, for at least two important reasons. Money printing during the pandemic was materially less extreme in Europe than it was in the US. Hence, the excess monetary overhang is far closer to exhaustion. And then secondly, the extreme adverse shift in the energy terms of trade. Whilst US energy costs comprise about 6% of GDP, in Europe, energy costs are as high as 20% of GDP, off the scales. And if sustained for any period of time, such a dramatic deterioration in the terms of trade will swiftly absorb all remaining excess deposits and swiftly eat into household discretionary spending, potentially triggering loan defaults and deflation. So what does that mean for interest rate policy? Potentially very strong interest rate hikes in the US, not so strong by long margin interest rate hikes in Europe and possibly the UK. Policy divergence. Dangerous market dislocations usually arise when there is international policy divergence. US rates and consequently bond yields have further, perhaps significantly further upside. Meanwhile, the situation in Europe is almost the exact opposite. Not very cheerful. That's very much a long-term view on inflation and interest rates. A slightly shorter-term view, but also regarding monetary policy from cross-border capital. So these are the comments from Michael Howell at Cross-Border Capital. He called it very correctly in 2000, 2001, and also this year as well. Higher forex volatility, we've been seeing that, and higher bond volatility, we've been seeing that eventually pass through into higher equity volatility. The S&P 500 will likely test 3,200 points, maybe even 3,000 as earnings get crushed. This looks like a classic second leg down in the bear market. US Treasuries are signaling a potential drop of 20% in S&P 500 reported earnings in 2023. Bonds are highly sensitive to liquidity and are often the first asset class to feel the drain of cash from markets. So we need to take heed of what the US Treasury bond yield is doing currently. It hit 4% last night, was as low as 2.5% just 6 weeks ago. That is scary. There is a close correlation between liquidity injections into US money markets by the US Fed and swings in the S&P 500 index. S&P 500 3,200 index level may be coming. We continue to stress that liquidity has non-linear effects on markets. So everything could be going smoothly until it breaks very quickly and suddenly without warning. Something probably will break, but then we will buy into the markets. We'll use the liquidity that fortunately we have built up over the last 12 to 15 months and use that to buy aggressively into the markets once something is broken. How far further could the markets drop? Well, if we look at the classic bear market, often the first leg when PEs contract, we see a 25% decline. After that, markets often rally by 10% over the following 2 to 3 months. And we had that in June and July and August. And then finally, there's a sell-off of 15 to 20%. Investors should be prepared for that. But after that, according to Michael Howell, there is normally a surge in the markets over the following 2 years of around 40%. And that will be powered by a switch by the central banks, particularly the Federal Reserve, but also ECB and others, from quantitative tightening to further quantitative easing. So that is something that we should be able to look forward to in 2023. Not long to go. MRB, a little bit more bullish. The Federal Reserve signaled at its last rate hiking meeting in mid-September. Incidentally, that was the third consecutive 75 basis point policy rate hike. They now expect, and they increased their dot plots significantly. So the Fed now expects to end this hiking cycle with a 4.6% policy rate next year, much higher than previously projected. And this may indeed mark a peak in Fed hawkishness. The Fed will likely avoid a further hawkish policy reset for some time. And I suppose that is encouraging. It's a view taken very much by Casino of JP Morgan as well. Of course, that's different from macro strategy partnerships. Again, what do they say about the UK, Australia and Canada versus the US and other major developed market economies? This is MRB. Our high conviction in the solid underlying foundations for most of the major developed market economies is also matched by our elevated concern that some of the smaller developed market economies will prove to be the weak links that snap first in this cycle.
Hi, Nick. Thank you very much. Locally, Reinet, we own Reinet. M&G Investments announced that it has increased its shareholding in Reinet to 5%. Just something about M&G. M&G is a global investment manager in London. It's a big company and an old company. It was big because constituent of the FTSE 100 index formed in 1931. Then Investec, they released a trading update for the 6 months to the end of September. They expect headline earnings per share to be about 38% higher. The earnings are looking good and solid. Then Anglos, they started a new copper mine in Peru. The mine is now active. They have started copper shipments from the mine after successful testing of operations and after they got the final regulatory clearance. The CEO of Anglos, Duncan Bandat, he said it's a new world-class copper mine. The mine is technologically advanced and it produces copper at highly competitive operating costs. Grindrod, we own Grindrod. Rembrandt owns 25% of Grindrod. And Rembrandt announced yesterday that they are unbundling some of his assets. They have already unbundled First Rand and Mediclinic, and the next one on the block will be Grindrod. They will distribute 174 million Grindrod shares as a dividend in specie to their shareholders. It won't affect Grindrod as a company, it will only affect Remgrowth. But the Grindrod shares did take a dip yesterday after the announcement. There will be many small lots of Grindrod on the market and the people will probably try to get rid of that. In foreign net selling of shares on the JSE year to date, we reached the 70 billion mark yesterday. And then statistics. All are aware of the inflation figures that came out. Inflation was 7.6% for August. That's year on year. That is this August compared with last year's August. And then interest rates, as we expected, there was a 75 basis points hike in the interest rates. It's now 6.25%. core rate and the prime rate will be 9.75%.